Lightspeed Commerce opened earnings week down 11% in the first hour of trading, and then something unusual happened. The stock recovered. Not because the numbers were exceptional, revenue came in at US $1 billion, up 14%, but because the market read past the headline decline and priced a structural shift that had not been visible in prior quarters. Chief Executive Dax Dasilva declared the end of growth at all costs. That phrase carried more capital flow weight than the revenue figure itself. The position pressure change that made the recovery rational was a prior overhang of growth mandate institutional selling. Lightspeed had spent years expanding across too many markets, accumulating holders whose mandates required revenue acceleration above profitability. When Dasilva confirmed the Upserve divestiture and laid out a 3-year free cash flow target of $100 million, a portion of those holders had their exit signal, and a different capital class entered. The intraday reversal is interpreted from price and volume action alone, since specific fund flow data is not available in the news pool. What the pattern signals is that the seller class had already repositioned before the print, and the recovery absorbed retail and value-oriented domestic buyers, reassessing the risk structure. The frame disturbance matters here. Lightspeed's growth engines now represent 75% of revenue, with North American retail and European hospitality as the two named concentrations. Dasilva expects that figure to reach 80% within the year. That is not a growth story. That is a margin density story. And the market's prior allocation frame, which priced Lightspeed against Shopify on total addressable market, was the frame being repriced during that intraday session. The question the recovery leaves open is whether the repricing held because the fundamental shift is real, or because Lightspeed's peer set on the TSX has also been quietly correcting its own valuation logic.
The answer that Lightspeed's recovery left unresolved, whether TSX valuation logic is shifting broadly, shows up most clearly in Exchange Income and Dream Industrial REIT, two names where the fundamental data moved significantly ahead of price recognition in Q1 2026. That gap is not a growth stock discount. It is a capital allocation delay specific to complex business structures that institutional investors price on a lag. Exchange Income reported Q1 revenue up 30% year-over-year to $866.6 million, with net income rising 287% to $27.9 million, and EPS climbing from 14 cents to 50 cents. The business spans aviation, aerospace, medevac, and defense services, a portfolio that resists simple sector categorization and therefore sits outside the passive flow universe that dominates TSX large cap rotation. The capital class absent from Exchange Income's price reaction is passive ETF money. The capital class present is concentrated domestic institutional buyers who track cash flow yield rather than index membership. At a 2.6% dividend yield and 30.5 times earnings, Exchange Income is not cheap on a headline PE screen, but the implied cash flow trajectory from Q1 argues for a multiple that the current price has not yet granted. Dream Industrial REIT sharpens the same point from the real estate side. Comparative property net operating income grew 9% in Q1. Committed occupancy reached 95.7% nationwide, with Canadian occupancy at 96.8%. Rental spreads hit 26.4% total and 33.1% in Canada alone. Management bought back $97.2 million of units at an average price of $12.95 against a net asset value of $16.76 per unit. A buyback that functions as an explicit management signal about where they believe intrinsic value sits relative to market price. The capital flow here is a rotation from foreign net sellers into domestic REIT specialist institutional buyers who price on FFO guidance of $1.08 to $1.10 for the full year. That guidance anchors a 5.1% yield at current prices. The TSX's own fundamentals-driven capital is accumulating below NAV, and the question that accumulation raises is where yield-seeking income allocators, those without an industrial REIT mandate, are placing their highest conviction position today.
The highest density yield answer in today's news pool is MCAN Mortgage, which carries a 7.1% distribution yield at $24.60 per share, with assets under management now reaching $8.3 billion, up 35% year-over-year. The position pressure shift that makes this flow rational is a combination of rising TFSA contribution room, now exceeding $100,000 cumulative for many Canadian investors, and a structural demand for tax-free monthly or quarterly income that cannot be met by Fortis at 3.3% or Royal Bank at 2.6% without taking on significant equity volatility exposure. MCAN's Q1 results confirmed the mechanism. Net interest income rose 8% year-over-year. Net profit surged 39%, driven by a 43% increase in equity income from its MCAP partnership and realized gains on securities. Return on equity reached 14.2%. Uninsured residential mortgage balances grew 4% year-to-date to $4.7 billion, with an average loan-to-value ratio held at 67.4%, a number that matters because it sets the stress test ceiling for the securitization program, which is the growth engine the market is pricing when it grants MCAN a premium over simple mortgage trust peers. The capital class entering MCAN is income-oriented TFSA holders rotating out of broad market ETFs like BMO Equal Weight REITs, which yields 4.1% but charges 0.61% in fees and provides no MCAP equity upside. The rotation is from diversification first income into concentrated yield income, and the position pressure that makes it rational is the compression of yields across Canadian REITs and utilities into a band that no longer compensates for equity drawdown risk. The dominant reading today is that the TSX's fundamental repricing, Lightspeed's margin turn, Exchange Income's cash flow gap, Dream Industrial's NAV discount, MCAN's securitization growth, is a coordinated shift in how domestic institutional and TFSA capital is pricing certainty, not sector rotation, a certainty premium. The monitoring variable is MCAN's uninsured securitization program. If balances continue expanding at the current 4% pace through Q2, while the loan-to-value discipline holds below 68%, the 7.1% yield becomes structurally defensible. If the securitization program stalls, or if MCAP equity income reverts from its 43% growth pace, the yield premium compresses and the rotation that price it unwinds. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.